Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves the markets. I'm highlighting the word weekly this week because, Rob, you're back in the studio with me 2 weeks in a row. What is going on? Why are we doing this?
We can't stay away, Miles.
Fair enough.
Well, you had pointed out some of the comments from listeners last week.
Yeah, I made a mistake. We have somebody who goes through all of that stuff for us. I made the mistake of going through it myself because I thought it was a pretty decent conversation we had last week. Yeah. And I was curious what some of the follow-up was. So this is going out to all you guys who join us every week. This is a very special show. Specifically for you because I saw a running theme in the comments from last week, and it made me nervous because what it told me is I'm not doing my job correctly.
Exactly.
And what job am I not doing correctly, Rob?
We're not framing our conversation in terms of the time frame. We are looking 1 to 2 weeks out when we speak, not 2 to 3 years out. And I think clients sometimes misinterpret what we're saying. We haven't gone from bullish to bearish. We're just looking at the short-term trends, which we can see technically. And then we're going to get into that today. And I really appreciated the comments. I mean, because I'd like to know what people are thinking on the other side of the microphone.
Right. And you and me and the guys around the office here, we have the potential problem of getting stuck in our own echo chamber and saying the same things back and forth to each other over a period of time. And sometimes it takes somebody from an outside perspective to go, wait a minute, what did you just say?
Well, and I will say this. You warned us for the last year, your thought that we would see 1680 gold again. That was still on the table. And I listened to you, I heard you, and here we are.
And we're probably going to see it again. And I think that was the purpose of our conversation last week, because amidst, and Rob, you've got some numbers for us that I want you to rattle off here in a second that you put together, but amidst the concerns that we're seeing in our clearly stagflating economy, possibly depressive economy right around the corner with very little expectation of growth over the coming years, for me to sit here and give the impression that we're looking at a long-term bear market in a protective asset like gold was obviously a clear failure on my part. So this is our chance to dig deeper into the conversation of what do we actually think gold's looking like short-term versus medium term versus long term, and make sure we are specific in those differences.
Well, in just the first half of this year, which we are now in the second half, the NASDAQ is down 25%, the S&P is down 18%, the Dow is down 15%, and the transports are down 19%. Now, those are the indexes, but if you look at the FANG stocks, like Google is down 18%. Amazon is down 32%. Facebook, now Meta, is down 50%. Netflix is down over 67%. So what we are seeing in our little echo chamber of gold is everything around it in terms of the equity market and the bond market falling. The yield on the 10-year Treasury is up 65% this year. You know what that means to the underlying value of the bond itself. It has plummeted. 30-year is up 45%. The dollar is up 13%. So what has gold done in the midst of that, and where are we likely to be in the next few weeks? Well, gold is down 3.7% for year to date. So it has responded, but mostly is treading water. And I do see a strong possibility of another 3% drop. That's it. That's all we're talking about. We are not talking about a bear market. We are talking about a buying opportunity for people who are sitting on money on the sidelines looking for an entry point. Now, does that mean you wait for the magic number? Do you wait to buy gold at 1680? Just like people were waiting to buy silver at 1875. Well, guess what? It hit 1875, but it did it in London, not in New York. So you can't wait for the magic number. I think now's a great time.
So I was doing a little research before we came in here today, and one of my favorite YouTubers, Max, over with Stoic Finance, referenced one of my favorite statisticians, John Williams, at Shadow Statistics. And I'm hoping all of our listeners are familiar with both of those names, and if you're not, you definitely should be. John Williams put out new numbers today, July 13th, 2022, showing stated rates of inflation currently because new inflation numbers came out. So inflation in June up an additional 9.1%. That takes total inflation stated rate of inflation based on how it's calculated today to 8.6. So we're sitting at a pretty high but not terrifying inflation rate number based on how they calculate the numbers today. I'm going to keep saying the phrase based on how they calculate the numbers today because John Williams in Shadow Statistics does a pretty interesting thing. He goes back to the Jimmy Carter and Pryor era of figuring out how inflation is calculated.
Yeah, the formula that was used during Jimmy Carter's era would put us at what? 17?
About 17, a little over 17% inflation. And that feels a little more realistic when you're swiping your credit card. Certainly at the gas tank.
Oh, yeah. And he was bringing out that is the third highest inflation rate going back to 1920 and again 1947.
Right. So 17% inflation, which is how they would have calculated it back during those eras. 17% inflation today. That compares to a staggering 19.6 in 1947. You guys probably all know what 1947 was a few years after. And finally, 24% in 1920, which is the previous World War just before that. So we're not too far off from the highest inflation rates in history, and we are not following on the heels of two of the biggest, most deadly wars in history. So what makes me nervous is we are currently at a rising inflation rate, rising CPI, Consumer Price Index, up almost 16% since March 2020. So that's stated CPI, but PPI, Producer Price Index, up 47.5% in that same time period. So businesses are having to spend more and more money to buy the raw materials to make the goods in which us as consumers are paying marginally more for comparatively. So we're looking at this massive increase in inflation today compared to two of the most ridiculous times in history as far as inflation goes. And personally, I think we have a long way to go in this. So am I bearish on gold on the long run?
Absolutely not.
Absolutely not. So I think it's important to take a look at this. Again, you said at the beginning, right? We're a weekly show. So we are going to look at this. And one thing we've been saying for the last couple months is there is some legitimacy to sell in May and go away. And we're right in the middle of the summer doldrums. So you have to look at the precious metals pricing in what we like to call the short term, which is a year or less. The medium term, 3 to 5 years, and the long term, which is your entire market cycle, which can take a decade or more. So you have to look at this from varying levels and take a look at this gold chart here where we're signaling the long-term market bottom, which was back in December of 2015 at around a little under $1,100, to the high we put in 2020 and then retested at the beginning of this year. You draw the fib numbers on that, and we're at a very shallow correction, the 382 correction on the fib numbers. Well, your medium term started at the breakout point where we confirmed it was the end of the multi-year bear market in gold and the beginning of the multi-year bull market in gold. So the last bottom we put in would have been May of 2019. You draw that to the high, and lo and behold, you've got about a 50% correction from that starting point, stacked right on top of that longer-term 382 fib. Finally, you've got this kind of emotional panic move in gold, which occurred after the March 2020 COVID decline in all the markets across the board. And you're at the 618 fib in the short term. So it's always amazing to me when you have multiple indicators in multiple time frames all lining up within the same price range of $30 up and down, give or take.
Yeah, and that's where we are. We are very, very close to that intersection. So I mean, I know I bought gold a few weeks back believing that gold probably would drop, and I mentioned this before, but I didn't care. I just didn't want to have to leave my money in the bank or in the dollar because I really have lost faith in the leadership of our country, both politically and financially. And I said I'd rather lose money in gold than worry about it in the bank.
Well, and you can draw that over to the other metals as well. So take a look at the silver price. Now, silver moved later. Silver tends to follow gold. I would argue it still has the potential to do better than gold, and that was another viewer brought that up, just the gold-silver ratio. We haven't talked about that in a few weeks. But you look at silver, and one of our coworkers, Mike, sent a chart around showing where silver had come right into in the last couple days. It's 618 fib. Now, silver is a little harder because your short-term, medium-term, long-term chart are all kind of the same chart because it put in the same bottom back in March of 2020. It took silver a few years longer to get going, but it's had a pretty significant jump up since then. And silver is already at a good potential reversal point now, one which I think you and I agree, based on what we said last week, gold's probably going to get to over the next couple weeks. And mentioning that gold-silver ratio, since we looked at gold and we looked at silver, you're looking at the gold-silver ratio, at least the spot price is now up to 90, which is a very good entry point for the silver price when you look at the long-term gold to silver price comparison over, say, the last 50 years. Now, what does 90 actually mean in the metals market today?
Well, it's paper versus paper. And just beware of premiums that you pay when you buy silver coins. The best value, like we have been talking about, is a 1,000-ounce bar at just over 10% premium to the futures price. But that's beyond most people and not something that they want. They want to have it in hand. But you're looking at serious premiums on silver coins, which have been coming down, but they have a lot further to go before I get excited.
Sure. So is there any silver for the guy that doesn't have the money to buy a $30,000 single bar that you'd consider?
I think 1 ounce COMEX rounds, I'm not talking about generic rounds that are minted by who knows who, but good delivery COMEX rounds in silver, qualified for IRA accounts. That's a decent value. Still a bit of a premium, but a lot better than a 53% silver Eagle premium.
Right, and you mentioned the COMEX word. What does that mean? Why would someone care?
Well, they're good delivery rounds. So when you take those coins, how much is it going to cost you? How can you get hurt? What happens when you want to get rid of it? When you sell a non-COMEX silver round, nobody wants it because they can't put that back in the depository. It's not qualified for an IRA. And that's where the broad majority of silver ends up eventually. So if it's not qualified for COMEX delivery or cannot be used for an IRA, the dealers might buy it, but you're looking at a 10 to 20% haircut possibly,
right,
when you go to lay it off to a local dealer, because he's got nowhere to go with it other than leaving it in his counter and waiting for somebody to buy it.
So you want to make sure you're specific, not just in the metal you're buying, but what form it's in.
Correct.
Because you want to get as close to that 90-to-1 ratio as you can,
Correct.
And you want to start bringing things like silver in. So I did do the math before we came in today. Coin-to-coin price differences, that ratio is actually more around 78 or 79, which is still pretty good.
Yeah.
Not good enough for me to put everything into silver. Well, in fact, I still want more gold than silver, personally.
Yeah. But, when you come out of gold and into silver, you have to look at the bottom line. What is the true ratio? And what is the real price of silver? We've talked about that before. Is it the COMEX price or what you can own it for?
So there are definitely ways to build and manage your precious metals portfolio with gold, bringing silver in based on these ratio pricing, because what we're looking at here is despite short-term sell in May, go away, you and I have a conversation about the short-term bearish nature of gold and expecting it to come down a little bit cheaper.
Yeah, 3%.
Yeah, we're still really bullish.
5
on the
years
metals.
from now, what is that going to matter? If you're worried about squeezing the last drop out of the turnip, then you might want to wait for gold to hit 1680. But I'm not worried about that. Long term, 5 years from now, will we remember if we paid 1730 or 1680? We will not remember. What we will be seeing is a much higher price for the metals relative to the dollar. But in my opinion, gold will continue to be able to buy, probably with a bonus, what it buys today. So I see not just gold keeping up with the loss in purchasing power, but I also see a little bit of a bump beyond that. Maybe as much as a 20 to 30% actual gain in what it is valued at, what you can buy today. Now also too, when you look at consumer goods, what would a 3-bedroom, 2-bath house cost in 5 years versus today?
Probably more U.S. dollars, but the same number of ounces of gold.
But that's getting back to what I was trying to say earlier. I think you could actually buy a home. I think there'll be an overcapacity at some point, and homes will go down in value because what we're going to experience is inflation and deflation occurring simultaneously.
Right. And we're definitely starting to see that in the housing market now.
Yeah. And housing prices are going to come down to a degree, but you'll have inflation and deflation occurring at the same time, sending mixed signals to people. And this is something that Don McElvaney talked about 40 years ago. And what we see with gold is not just maintaining a purchasing power, but actually adding value to consumer items. We'll see how it all plays out. Bottom line, gold is going to do just fine, and it will hold its ground like it has so far. I'm hardly calling a 3.5% drop in gold since the beginning of the year a bear market.
Especially amidst everything else that you already
Exactly.
pointed out.
Yeah.
And since you brought up housing, the NAHB Housing Market Index already down 20% since December.
Interesting.
So we're already seeing the housing bubble start to pop. Where is the money going to go from here? It's not going back into the equities market. It's not going back into real estate. It's not going into the bond market. Why would you buy a bond today if they actually keep interest rates going up? It's better to wait a little bit longer. Where's your money? And it can't sit in cash because you're just losing purchasing power at 8.6% annualized stated, or 17% if you like to use the numbers that people actually used to use.
Yeah, 17% actual versus 8% stated. Yeah.
So where do you put your money nowadays? So when we talk about a decline in gold, please understand we're talking about opportunity, not concern.
I like that.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell. Head on over to our website at McElvaney.com. You can find us on Twitter at ICA Gold or Facebook at McElvaney Financial. And if you'd like to speak with one of us about your personal precious metals portfolio, give us a call at 800-525-9556. Thanks for listening and have a great week.